Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got red on the screen overnight on Wall Street. The Dow Jones Industrial Average lost more than 800 points, dropping to 41,860. The S&P 500 lost 1.6% to 5,844. And we have the Nasdaq Composite losing 1.4%. And it seems like some concerns are coming back to the market with the spike in Treasury yields. And that's seeing the 30-year Treasury bond yield trading at around 5.09%, touching the highest levels going back to October 2023. And checking in now with us is Shane Oliver. He is the Chief Economist and Head of Investment Strategy for AMP Capital. Shane, good morning. How are you doing today?
Good morning, Ryan. I'm good, thanks. Hope you are well. Hope you are too.
Doing well as well, Shane. Well, I'm going to get help here to unpack what's going on with the markets, what's driving the sentiment lower right now. It seems like there is a lot of concern around what's going on with bonds. What's driving these bond yields higher?
It's basically a combination of things. I guess we need to put it all in context. We saw those big falls in the US share market going into April on the back of Liberation Day, if you want to call it that, tariffs from Donald Trump. He then backed down, shares rallied, recovering a big chunk of their loss, such that they're only 3% down from their all-time high. That left the market somewhat vulnerable because the tariff concerns are still there. And now swinging into focus is concern about the US debt situation. And that's partly been because Congress is talking about what is called this big, beautiful budget bill, a big, beautiful bill, I think Donald Trump calls it. This is his tax reduction bill, which is now being debated by Republicans in Congress. And there's two groups there. One group wants to increase the size of deductions for payment of local taxes, state and local taxes. Another group of conservatives on the Republican side in Congress want to cut more spending so the budget doesn't keep blowing out. But anyway, that's shed more light, more increased focus on the budget deficit in the US, which remains huge at nearly 7% of GDP, and public debt, which in net terms is around 100% of GDP and will get worse given the budget bill that's going through now. So that's been bubbling in the background. Then, of course, we had the Moody's downgrade earlier in the week or late last week. And then, of course, today or overnight in the US, we had a bad bond auction for the 20-year bonds. Not a lot of demand for bonds in the US, which obviously finances the budget deficit. That saw bond yields. The 10-year bond yield rose quite substantially, here up 11 basis points to 4.6%. And, of course, the 20-year, as you mentioned. So that's what's driving it. That, of course, then fed back to the share market because higher bond yields, higher long-term interest rates make shares more expensive from a valuation point of view. And suddenly the market's getting nervous again with those sharp falls. So it's basically, we've gone from one concern about tariffs to now focusing on the sustainability of US public debt as the new concern. And that, of course, is causing more upwards pressure on bond yields.
Yeah, a great overview of what's going on right now. Shane, talking about the Moody's downgrade of the credit rating for the US from AAA, the top level, to AA1. How much is a factor in terms of the funds that buy into these bonds now having to think twice because they can't go below AAA, and in that sense, that feeds into the weak demand for the bond space. Is that going to play out in the coming quarters, coming months? Is that going to mean more pressure on bonds?
It could well do. I tend to think that the Moody's move was just a catch-up to the moves by Standard & Poor's back in 2011 and Fitch in 2023, who took the AAA rating in the US down to AA+, I think it was. So Moody's is really just catching up. So you could argue that that adjustment has probably already occurred, unless, of course, an investor is relying solely on Moody's, in which case then it would have an impact. On Monday, the market didn't seem to worry about it too much, and Monday and Tuesday. Now, of course, suddenly the market's starting to worry about it more. So that Moody's move, on the one hand, it's a bit of a non-event. It's just a catch-up to the other ratings agencies. On the other hand, it is significant to the extent that it's just highlighting there's that ongoing issue there. Moody's were obviously hoping that things would come under control and then now realising that maybe they're not and then have had to downgrade. So I suspect this issue has a long way to play out because the budget projections for the US budget deficit show it staying around these very high levels, that 6-7% of GDP, possibly getting worse depending on how the tax bill is resolved finally. But, of course, to stabilise US public debt at current levels, the biggest budget deficit you can have needs to be around 3% of GDP. So it's double what it really needs to be to stabilise debt. There's a bit of complicated maths involved in all of that. But bottom line is anything above 3% of GDP for the budget deficit means that the debt to GDP ratio will keep rising. And, of course, that will put it above most countries, well above what it is in Singapore, for example, well above what it is in my country in Australia. I think the only country with higher debts is probably Japan, although that's a complicated story. They've got lower borrowing costs generally. But that it does go to question the safe haven status of the US. We've seen the US dollar remain under pressure right through this period.
Yeah.
The US dollar has remained under pressure despite the back down on the tariffs.
Yeah, that's the next point I want to bring up, right? The US dollar touching its lowest mark in a month. And I think that to some degree has to do with where things are with US debt concerns, the bonds, the yields as well. Where do you see the dollar going and what's going to drive it further?
Well, that's an interesting question. It obviously had a massive fall going into those in the lows in April, and that's when there's a lot of talk about the US losing its safe haven status. Because normally what happens here, when there's bad news and uncertainty, US bonds rally, US bond yields come down because they're seen as a safe haven, and the US dollar rallies. This time around, it's been different. We had the tariffs and the US dollar fell. There was a back down on the tariffs, the US dollar rose. Now the US dollar's coming back down towards its April lows. And I suspect there's a high risk that it could go below that and keep going down. Now, technically, you could argue, well, it's getting a bit oversold, get a bounce at some point, but I suspect the broader risk for the US dollar is down. And there's also uncertainty as to what the Trump administration wants for the US dollar. Some say, well, we still believe in the mighty US dollar. We still have a strong dollar policy. Other policymakers in the Trump administration tend to say, well, the strong dollar is bad for us. It makes our exports less competitive. So it's a bit unclear as to what their policy is and what they really want, and that's confusing things as well. But anyway, it just seems like investors globally are voting with their feet and saying, well, there's too much risk around the US. Donald Trump is creating a lot of uncertainty with all these policy backflips, and now we've got these big concerns about the budget deficit and debt.
Yeah, there is a lot of speculation about what the Trump administration wants, and there is a lot of speculation that they want a weaker U.S. currency. How will that play out for the other parts of the markets, the equity space, for example, with companies earning in terms of foreign exports? A weaker U.S. currency would mean better earnings down the road. Would that be the right way to look at it?
It is the right way. It does help US multinationals who have operations abroad, whether it's in Asia or Europe or wherever, because the value of those earnings will go up when converted back into US dollar. The US dollar's going down. So in that sense, it's good news for US big companies. The tariffs, of course, work the other way. The tariffs are better for US small companies that have their operations in the US and can better compete with imports as a result of the tariffs, whereas multinationals would have been harmed by the tariffs because they face retaliatory action from other countries. So it's sort of, the Trump administration's proven to be a bit of a mixed bag here for different parts of the US share market. But I think all up, a fall in the US dollar would probably be welcomed by large companies in the US, although they're not going to say that publicly, but it would boost their earnings.
Yeah, Shane, let's look into your crystal ball right now to wrap things up. Where do markets go from here? Because we have right now, it seems like, an environment of deal-making more than tariff, slapping. Is this going to be, I suppose, more upside in the days ahead?
Well, I think it's going to be very messy. I think there will be more tariff deals announced. Markets will cheer that and be happy with that. But by the same token, the tariff story could still get worse from here. I think what we saw in the backdowns is probably about as good as it's going to get. Most of us will still end up with a 10% tariff slapped on our goods when they go to the US. We probably won't get much improvement from that, and Trump has threatened in recent days that he still might put tariffs on some countries that don't negotiate or he doesn't have time to negotiate with. So that's going to confuse things. He's still talking about tariffs on things like pharmaceuticals and semiconductors. Who knows where the negotiations with China will end up. So I think it remains fairly messy, and we've got these debt concerns which are bubbling away. And in the meantime, we're likely to see weaker economic data as a result of all this uncertainty flowing through. So it still remains very messy, I think, for the US share market and therefore for shares globally, given all these issues. I'm also conscious this is May. The old saying, sell in May, go away. So I think we're in for several months of volatility. That said, I know technical analysts listening to this or thinking about the US share market would say, well, the rally's been really good. It's actually had good breadth, good participation across the market. We've seen cyclicals doing well, which is a positive sign. So that confuses things a bit more. There are some positive technical aspects of this rally that have occurred. But by and large, I think it's going to remain a pretty volatile ride for a while yet. Later in the year, once we get more clarity on tax cuts maybe in the US, deregulation, and that might help share markets, and maybe the Fed starts cutting interest rates, that could help. But I think for the time being, it's going to remain fairly volatile.
Yep, fairly volatile indeed as we wait for perhaps even sectoral tariffs to kick in, like you pointed out, against some sectors like pharmaceuticals or semiconductors. So lots of moving parts to watch out for. And of course, we are very grateful for your insights today. Shane Oliver, Chief Economist and Head of Investment Strategy for AMP Capital. Shane, thanks for your time and have a great day ahead.
My pleasure, Ryan. Great to speak to you, and you have a great day too.
All right, we'll catch up again soon. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.